Okay, so we have finished our discussion on MM theorem. There are basically two parts. The first is the MM theorem without taxes. The second part is the MM theorem with corporate taxes and personal taxes. So what are the major results? For the MM theorem without taxes, we have two different propositions. Proposition 1 says, no matter how you change your capital structure in a perfect capital market, your firm's value will not change. And then based on this, we have MM proposition 2. That is, if you increase your firm's leverage, the cost of equity in your firm will also increase. And then we did a example, which is about this leveraged recapitalization. And our finding is, in a world without taxes, leveraged recap will not change your firm's value, and it will not change your firm's stock price. And then we move on to the more complicated and realistic case. That is, there are corporate taxes. And we learned with corporate taxes, using leverage, debt will generate this so-called interest tax shield. The reason is because interest expense is considered as tax deductible. So interest expense, which is essentially the payment to debt holders, is shielded away from corporate tax. So if the firm increases its leverage, then the firm's interest tax shield will increase. This will ultimately increase the firm's value. And then we also did a application, which is again this leveraged recap. And in a world with corporate taxes, leveraged recap will increase the firm's value. And because of this value increase, firm's stock price will also increase. And then we look at the case with personal taxes. So the major result is, because generally the tax on interest income is higher than the tax on equity income. So the benefit of debt will be reduced when you consider personal taxes. To measure that, we defined this effective advantage of debt. And then we move on to examining the empirical evidence. That is, we want to see whether our theory about debt can actually explain our observations from data. So what are our findings? The first is we find out generally firm would only use a small portion of, generally a firm will only finance its capital expenditure with a small amount of debt. The larger amount is to use the retained earnings. And then we find out, well, this reason is because a firm could only enjoy the tax shield only if the firm has taxable earnings. This implies a firm's interest expense cannot exceed EBIT. And then based on this result, we continue to examine empirical evidence. And we find out in reality, right, at least for Canadian firms, the ratio of interest expense versus firm's EBIT almost never exceeded 35%. So we asked why. And then one possible reason is there are some additional costs when the firm uses debt. So today we're gonna talk about several different kinds of additional costs from debt. And we will also talk about some additional benefits of using debt. And the first additional cost of debt we want to talk about is the bankruptcy cost. So let's start this new chapter, right, which talks about additional costs and benefits of debt. So when a firm is having some trouble or it is failing to meet its debt obligations, then we say this firm is in financial distress. And if a firm is in financial distress, it will suffer from some financial distress costs. One important type of such financial distress costs is the bankruptcy cost. So what is bankruptcy? Well, to understand bankruptcy, you will start with default. So basically, if a firm fails to make the promised payment, either the coupon payment or the principal payment, then the firm is in default. So generally, default will not necessarily lead to bankruptcy. However, if the firm cannot solve this default problem, in the end, there will be bankruptcy. So basically, in the extreme case, the firm will have to file for bankruptcy. And then what happens is, in the bankruptcy process, the debt holders, right, they will take ownership of the firm's assets. And this process, this bankruptcy process, is very costly. So there will be bankruptcy cost. You can imagine that if you're a firm and if you're filing for bankruptcy, then basically you can very quickly find out you have to hire some lawyers. And we know that lawyers are expensive, right? And then potentially you will have to hire some consultants who could guide you through this whole bankruptcy process. So we know that hiring management consultants is very expensive. And then you could also imagine that if you're filing for bankruptcy, then your customers, potentially they will just leave you. And this will create a huge drag on your business. So this is very costly. And your textbook actually discusses these several different kinds of costs in details. So if you have time, you could read your textbook and then you could understand very specifically what are these different types of bankruptcy costs. Okay, so now we want to ask the following question. That is, if there is bankruptcy, will the risk of bankruptcy reduce a firm's value? Well, the answer is no if you're in a perfect market. The reason is, if it's a perfect market, there is no bankruptcy cost. So you have to note the difference here. Here, we are asking how the risk of bankruptcy will affect firm's value. We are not asking how the cost of bankruptcy will affect firm's value. So basically, the risk itself will not affect firm's value if the capital market is perfect. So let's see this example here. So this firm is developing a new product. And if it is successful, then the firm will be worth $150 million at the end of the year. And if the product development fails, then the firm will be worth only $80 million. Now, the firm can choose two kinds of capital structures. The first is all equity financing. So you can quickly find out. So you can quickly find out if the firm is doing all equity financing, then obviously there will be no bankruptcy cost, right? Now, the second way or the second type of capital structure is the firm would use a mixture of debt and equity. To be more specific, in this case, the firm is using a $100 million of debt. And this is, so here this $100 million is the face value of the debt. That is, $100 million will be due at the end of the year. Okay, let me write down this. That's weird. Why I can't find the... Oh, great. So, so by using that, $100 million will be due at the end of the year. So this 100 million is the face value of the debt. So let's see the payoffs under these two different kinds of capital structures. First, without leverage. Well, that's pretty easy, right? We don't have debt. And we know that the firm's value is $150 million if the product is a success, and $80 million if the product is a failure. And because the firm has no debt, then we would know that the firm's value is equal to equity value, right? So now we could find out the value of equity. And obviously, the firm would only have equity investors. So the total to investors would be 150 and 80. This is the basic simple case. Now let's look at the second case. That is when there is leverage. Now if the product is successful, then the firm's value would be $150 million. And we know that the debt has a face value of $100 million. So you can see that essentially the firm will have to pay $100 million to debt holders. And then the residual amount of $50 million will be the value to equity holders. So again, the total is $150 million. Now, the interesting case is if there is a failure. In this case, the firm's value would be only worth $80 million. However, the debt has a face value of $100 million. So this basically implies that in this case, the firm will not be able to pay back its debt. So the firm will have to file for bankruptcy. And debt holders will take ownership of this firm. And it will only get $80 million. And then because in this bankruptcy process, the firm has to first pay debt holders. And if there is only a residual amount, this amount can be paid to equity holders. If there is no residual amount, then equity holders will just get zero. So here, equity holders get zero. And the total payoff, of course, it's just $80 million. So what you can see here is the firm's value under these two different capital structures should be the same, right? Because the total cash flows to all shareholders are the same, whether the firm has leverage or has no leverage. Right? So if the firm has the same payoffs in the future, then their present value should be the same. So the firm without leverage and with leverage should have the same value. Okay. So what's the lesson here? Well, if we're looking at a perfect capital market, bankruptcy does not make investors worse off, right? It just shifts the ownership of the firm from equity holders to debt holders. And obviously you can see that if you compare the investors' payoffs, you can see that if there is a product failure, then the loss is $70 million, or the difference. And then you can see that, again, if there is a failure, then the difference in equity holders' payoff is 50. and in the payoff of the debt holders is 20. So again, it's a total loss of $70 million. However, you can see that in this case, the loss of $70 million is not caused by bankruptcy. It is caused by the failure of the product development. Right? So here, bankruptcy does not affect value. Obviously, a caution is this result would only hold if we are having a perfect capital market without bankruptcy costs. If the capital market is not perfect, then we have to pay bankruptcy costs. Then in this case, you can imagine that firm's value will be lower if the firm files for bankruptcy. Okay, now you could see that this result under perfect capital market is kind of obvious, right? Because this is really just a application of proposition 1. What's the content of proposition 1? Well, proposition 1 says if the capital market is perfect, then firm's value does not change, even if you change your capital structure, right? So here you can see that this example is exactly in the spirit of proposition 1, right? Even now we have this bankruptcy, but still firm's value does not change. Okay, now let's look at this example here. So the risk-free rate is 5%. And then the product is equally likely to succeed or fail. For simplicity, suppose its cash flows are unrelated to the state of the economy. So basically, you can see that it basically says a firm's cash flow has no systematic risk. So we could discount the firm's cash flows using the risk-free rate. Compute the value of Armin's securities at the end of the year, at the beginning of the year with and without leverage, and show that proposition 1 holds. So let's look at this table of value here. What you can see here is in the case of no leverage, then the firm's value equals the firm's equity value, and it equals the expected value of equity, that is 1/2 times 150 plus 1/2 times 80 divided by 1 plus 5%. So this gives us $109.52 million. And in the case of with leverage, so here we have to separately consider the value of equity and the value of debt. So what is the value of equity? Well, you can see that the computation here would pretty much be the same. You're just using different number, right? So it would be 1/2 divided by 50 times 50 plus 1/2 times 0 divided by 1 plus 5%. So this gives us 23.81. And then the value of debt would be 100 times 1/2 times 80 divided by 1 plus 5%. So this gives us 85.71. Clearly now the firm's value would be D plus E, which is the sum of these two numbers gives us 109.52. So you can see that the firm's value should be the same the firm's value should be the same without leverage or with leverage. Okay, now let's look at a more realistic case. So in this case, the firm has to suffer from this bankruptcy cost if the firm files for bankruptcy. And to be more specific, we assume the bankruptcy cost is $20 million. It's $20 million. And you can see that now the total value of the firm should be lower if the firm is using $1 million of debt, right? Because it will incur bankruptcy and bankruptcy cost. Okay, now let's see the value to debt and value to equity and value to all shareholders. So again, even with bankruptcy cost, the numbers should be the same if the firm is the numbers should be the same if the firm is not using leverage, because now the firm will not incur bankruptcy cost. And what you can see here is the number should change if the firm is using leverage and there is bankruptcy cost, right? To be more specific, this number should change. So what's the number we previously have? Well, previously, whenever the product development fails, debt holders will get $80 million. But now we have assumed there is a bankruptcy cost of $20 million. So essentially this means we have to minus $20 million from this 80, which gives us 60. Okay, so that's why you get the number, that's why you get this number 60 here, right? And all other numbers are the same, right? All other numbers are the same. Basically, if there is a success, then the $150 million of total value is divided by the debt holders and equity holders. And then in the case of product development failure, the firm files for bankruptcy, then debt holders get $60 million and equity holders get zero. So now let's see, compare the present value of this firm with and without leverage, given the data in this table. And assume the risk-free rate is again 5% and the new product is equally likely to succeed and fail, and the risk is diversifiable. So we will basically repeat the same process. The only difference is we will use 60 here. So the case of without leverage, right? So we get V equals E, which is 10952. So I'm basically just copying this number from the previous example, right? Because we have solved this. And then with leverage, then in this case, we're okay. So what is the value of debt? So here we will use this $60 million. I think it's 76.19, and equity would be so this gives us 23.81. So the total value of the firm is the sum of these two numbers, right? Well, obviously, if you just want to find out the value of the firm. You don't really need to separately solve the value of D and the value of E. You could directly use these two cash flows, right? So you can try this. And so you can see that the numerator would be, let me see, what's the numerator? So the numerator is 1, so the numerator is 105 divided by 1 plus 5%. This gives you 100. So what is the loss from this bankruptcy cost? So you can see that the loss is the difference in values, right? That is, you can compare these two numbers. So the difference between these two numbers gives you the present value of the loss. Of course, the present value of the loss could be calculated by, let me see, by the expected bankruptcy cost, right? So with probability 1/2, there is no bankruptcy cost. And with probability of 1/2, there is $20 million of bankruptcy cost. So the expected bankruptcy cost would be 10, then divided by the 5% discount. Right? So basically you can see that if you're trying to solve the present value of this bankruptcy cost, there are two ways, right? The more complicated way is you would first find out the firm's values with debt and without debt. Then you will look for the difference between these two values. That would be the present value of the bankruptcy cost. Or in a simpler way, you would just discount the expected bankruptcy cost by this 5% risk-free rate. Okay, okay, now let's ask this very interesting question. If you look at the previous example, right? What I can see here is, so if you look at these numbers, what I can see here is previously, when there was no bankruptcy cost, then the payoff to debt holders are given by 180, right? And when there is bankruptcy cost, now the payoff would be given by 160. And under these two cases, whether there is bankruptcy cost or there isn't bankruptcy cost, the equity value is always 50 and 0, right? So it seems that bankruptcy cost will only hurt debt holders, right? Because from this table, you can see that because of this bankruptcy cost, the payoff to debt holders when the product fails decreases from 80 to 60, right? Well, in fact, the interesting result is ultimately, in the end, equity holders will actually suffer from this bankruptcy cost. And in the end, not only debt holders should care about bankruptcy, equity holders should also care about bankruptcy costs. Right? So why? Well, the reason is you have to think the pricing of debt, or how debt is priced in the market. So basically, if debt holders understand the firm has higher default risk, then debt holders will ask for higher cost of debt, right? They ask for higher returns from the debt. This implies that the present value of the debt will be smaller. This essentially means the firm will raise smaller amount of money if the firm has higher bankruptcy cost. And we know that the purpose of raising money is to make new investment. So if the firm raises smaller amount of money, then maybe it will not efficiently invest in new projects. So this will reduce the firm's value, and this will actually harm equity holders, right? So to summarize, when securities are fairly priced, the original shareholders will pay the present value of the cost associated with bankruptcy and financial distress. Right? So basically, on the surface, it seems like debt holders will suffer. However, you can see that debt holders will eventually transfer their suffering to equity holders. So in the end, equity holders will suffer. Okay, now let's look at this example here. Suppose that at the beginning of the year, Army Industries has 10 million shares outstanding and no debt, and then Army announces plans to issue 1 year debt with a face value of $100 million, and it would use the proceeds to repurchase shares. Given the data in the following table, what will the new share price be? And in the previous examples, assume the risk-free rate is 5%, and the new product is equally likely to succeed or fail, and the risk is diversifiable. So basically, you just use the 5% risk-free rate as this discount rate. Okay. The main question is, what will be the new share price? So to answer this question, let's start with the question. What is the initial share price, right? Oh, this is actually quite simple because we know that without leverage, without debt, the firm's value is given by the discounted expected total value. I think this is 109.52. And this firm has 10 million shares. So this implies the share price is the total firm value. Well, because this firm now is a all equity firm. So total firm value equals the total value of equity divided by number of shares. This gives us 10.952. So you can see that this is the initial share price. Now, what's the share price with debt? The first step is we want to find out what is the firm's value if the firm uses 100 million of debt and if there is this bankruptcy cost. Well, again, we have done this, right? You would just discount these two numbers to find out the firm's value. Now, think about this. The firm will actually make the repurchase, right? Now, how could you find out the firm's new share price? Well, we will actually use a result we obtained in the previous chapter. Remember in the previous chapter when we talk about the leveraged recap, when there is tax, the main result is after the firm increases leverage, then the value increase will be shared by all original shareholders, right? To be more specific, in that example, to find out share price after the leverage recap, we will use the firm's levered value divided by the original number of shares. So here we will use this similar methodology. We will basically use the firm's total value divided by the original number of shares, right? So originally, or before repurchase, the firm has 10 million shares. So this tells us the firm's stock price would decrease to $10 per share, right? Okay. Now let's see. You can actually verify that. Indeed, the firm's share price will become $10. So let's verify this. So basically, the firm will actually the firm will issue a face value of $100 million. Well, how much cash can this firm raise from this debt? Well, the amount of cash the firm can raise is given by the discounted face value, right? So with 1/2, debt holders will get back their money because now the firm will not default. And with 1/2, debt holders will not get back their money. So it's just $60 million. And divided by 1/5%. So this gives us the present value of the debt. I actually forget what's the number here. I think it's 70.19. So $76.19 million. So this implies the firm can raise $76.19 million from issuing this debt with a face value of $100 million. So how many shares the firm can buy in the market? So number of shares bought by the firm is given by the amount of cash divided by share price, right? $10. So the firm can buy 7.619 million shares. So the number of shares left in the market is given by the total number of shares minus shares bought by the firm. So this gives us 2.381. Now we want to verify that after the repurchase, the share price is indeed $10. How do you verify this? Well, obviously you will want to use the total value of equity divided by the total number of shares. So what's the total value of equity? Well, the value of equity equals the firm's value minus the value of debt. And we know that after this leveraged recap, the firm's value will decrease to $100 million. And the present value of the debt is given by this. So 7619. So it's $23.81 million. And now you can verify that the share price is the total value of equity divided by number of shares left in the market. 2.381. So this gives us 10. So now you can see that the share price before the share price before the purchase and the share price after the purchase, they're both $10. Okay, now let's talk about the agency cost of debt. So obviously, we have finished the discussion on the bankruptcy cost of debt. Now, the second type of cost of debt is the agency cost. Now, what is agency cost? Well, it's actually a very important concept in economics. But here, agency cost specifically refers to the cost results from the agency conflicts between shareholders and debt holders. So basically, if the firm is using debt, then potentially managers they will make investment decisions which will benefit shareholders, but it will harm debt holders, and their actions will actually ultimately reduce the firm's value. And we will basically talk about three different forms of this agency costs of debt. And these are actually, mathematically, they're not hard. However, conceptually, you have to think about it and try to understand why these different scenarios will generate agency costs. So let's again start with this example. So there's a firm, Pasong, has a loan of $1 million, which is due at the end of the year. So if the firm uses its old strategy, the market value of its asset will be only $0.9 million. So clearly you can see that at the end of the year, the market value of its asset cannot cover its liability. So the firm will default. Now, let's say the firm is thinking about a different strategy. And this different strategy requires no initial investment. And the payoff of this strategy is like this. With 50% chance, this strategy will be successful. And then the value of the firm will increase by $1.3 million. And with 50% chance, the new strategy will fail. The value of the firm would decrease by $0.3 million. Now let's think about this. Is this a positive NPV project or a negative NPV project? Well, you can see that with 50% chance, the firm's assets will be worth 1.3. And with 50% chance, the firm's asset will be worth 0.3. So you can see that the firm's expected value after using this new strategy would be 0.8, right? So you can see that, so basically, under new strategy, the firm's value is 0.8. Under old strategy, the firm's value is 0.9. So basically you can see that this new strategy is a negative NPV project. It will basically reduce the firm's total value by $0.1 million. So you can see that from the perspective of firm's value, we should not, or the firm should not adopt this new strategy. The firm should adopt this old strategy, right? Okay, this is really the firm level decision. But what about the shareholder level? Whether shareholders will want to proceed with this new strategy or not, right? You want to ask about this, and you will find out, well, shareholders will actually be very happy to use this new strategy. even this new strategy reduced the firm's value. This is interesting, right? So let's see why shareholders will want to proceed with this negative NPV project. What you can see here is the firm has a debt of $1 million, right? So debt is 1 million. And then we have this project, which yields either 1.3 and 0.3. Now let's look at the shareholders payoff. So let's look at the shareholders payoff under this project. So basically you can see that if the project is successful, the firm will have $1.3 million of value. And then shareholders' value would be 1.3 minus debt, which is 0.3. And what is shareholders' payoff if the project fails? Well, it's just a zero, right? Because here the firm will basically declare bankruptcy. So this $0.3 million of value will be captured by debt holders. So equity holders will get nothing. Now, what is the expected payoff? So it's 0.3 with 50% chance. With 50% chance. And $0 with 50% chance. So the expected payoff is 0.15. Now, what is the firm's value what is the firm's value of equity if the firm sticks to old strategy? Well, we know that if the firm uses the old strategy, it will default. So you can see that in this case, the value of equity is just 0. And the choice is pretty obvious, right? It's 0 versus 0.15. So if you're the shareholder, you will definitely want to choose this project. Even this project is a negative NPV project. So why this could happen? So let's see. Let's look at this table and let's examine how the shareholders and debt holders payoffs would change because of using this new risky type of project. Okay, so first, the old strategy. Well, this is easy to see. The value of the asset would be $900,000 and debt would be worth $900,000. And because there is default, so equity's value would be just 0. Now, let's look at this new risky strategy. So if it's a success, now debt holders get back their money, equity holders get $300,000. If it's failure, then the value of the firm would be worth 300, debt holders will only get 300, and shareholders will get 0. So what's the expected value? Well, it's just the probability times the firm's value, that is 1, 300, and 300. Obviously, the expected value of debt would be 1,000 times 50% plus 300 times 50%, which is $650 million. So obviously, equity holders' expected value will be given by this. Now, think about this, right? So you can see that this negative NPV project will decrease the firm's value by 100, right? However, this negative NPV project will decrease debt holders' value by 250, right? Can you see this? Well, it's really the difference between 900 and 650. And it will increase the equity holders payoff by 150. So this is the change in the value of equity. This is the change in the value of debt. This is the change in the total firm value. So this basically tells you that, yes, this is a negative NPV project. However, the equity holders can still get this positive payoff from this negative NPV project. So how is this possible? Well, that's because the equity holders is gaining this positive increase in the equity value at the expense of debt holders, right? So debt holders, they suffer from a larger loss, and this loss is even larger than this negative NPV here. Okay. So this type of phenomenon we just discussed about is called asset substitution. So basically, if a firm is in financial distress, then shareholders can benefit at the expense of debt holders by investing in risky negative NPV projects. So what's the consequence of this asset substitution? Well, it will lead to overinvestment and reduced firm value. It's pretty easy to see So sorry for that. So what's the intuition for this? Well, think about this. If you're this equity holder, what's your worst scenario? Your worst scenario is your equity will be worthless, right? So basically you can see that if you know by using this old strategy, your equity will be worthless, then you have the incentive to take more risk because things couldn't be worse, right? Your equity value cannot drop below zero. So by taking more risk, even if it's a negative NPV project, then there is this potential that someday you will be lucky. And that lucky day would be your payday. And if you're unlucky with this new investment, you will just still get away with zero, right? So it cannot be worse. Why not try something risky? That's the basic idea here. Okay, now let's look at the second type of agency cost. It's called debt overhang and underinvestment. So now let's assume this firm is considering a investment which requires a initial investment of $100,000. And we assume for simplicity, the investment will generate a risk-free return of 50%. And then the current risk-free rate is 5%. So obviously, 50% is larger than this 5%. So this investment will have a positive NPV, right? So basically, on the firm level, we should invest in this project. Now let's say the firm needs to raise $100,000 in new equity to finance this investment. Now, is this possible? First, you have to understand that if the firm is trying to raise this money using new equity, it is essentially asking money from equity holders, right? So we have to examine whether equity holders is willing to give the firm $100,000 or not. Even this project is a positive NPV project, it's possible that from shareholders' perspective, they will not want to finance this project. So let's check these numbers. You will see that it's indeed the case. So, okay, we would still start from the base case. That is, we assume there is no new project, right? So we have seen this case, that is, the firm's value would be $900,000 at the end of the year, and the firm would have to file for bankruptcy, and debt holders will get back $900 million, and equity holders will get back nothing. Now, the focus is on this right-hand side. We want to look at values when this firm is taking this new project. So we know that the firm's existing asset has a value of $900 million. And we know that the firm has this $1,000 debt. And we also know that this investment has a risk-free return of 50%. So basically, you can see that the new project will boost the firm's value by 150, right? So the firm's value would be the old value plus the value from the new investment. So it would be it would be $1,050,000. Now, what is the value of equity? Well, it's 1,050 minus 1,000. So equity would have a value of 50. Okay, after examining these numbers, let's answer whether shareholders will want to finance this project or not. So what is the shareholders' benefit from this project? Well, it's just it's just 50 million. It's just $50,000. Right? That's the value of equity if the shareholder decides to finance this project. Now, what is the cost to these shareholders if they decide to finance the project? Well, we know that the firm is asking money from shareholders, and the amount of money the firm tries to ask is $100,000, right? So this is a negative number. So obviously the firm will not, obviously shareholders will not want to finance this project. We can also see how the benefit from this project is distributed. So let's first see the payoff from this project. we know that the project has a positive 50% NPV, right? So by investing $100,000, so the value from this project would be $50,000. Right? So that's like the total value increase at the firm level because of this project. And now we know that, and now we can see that what is the increase in the debt holders payoff? Well, without project, the value of debt would be 900. With new project, the value of debt would be 1,000. So you can see that the value of debt will increase by $100,000. Now, obviously, this minus $50,000 is the value decrease in the shareholder due to this project, right? So what you can see here is shareholders will not want to finance this project because because most of the benefit or most of the value increase from the project is captured by debt holders. And in the end, the residual benefits to equity holders will not be able to cover their cost, right? So in the end, shareholders will not want to finance this project. I mean, this one is actually pretty easy to understand. So basically, with this new project, the firm will have to pay back the debt. So even the value increase here is 150. However, this $100 has to first go to the pockets of the debt holders, and only $50 will be left in the pockets of equity holders. So they won't want to do this, right? They won't want to finance this project. And this phenomenon here is called debt overhand. You can see that this is really a very interesting name, right? So basically there is debt hang over your head, and then in this case, shareholders, they will not want to finance a positive NPV project. So you can see that the consequence of debt overhang is debt overhang will lead to underinvestment. Well, obviously there is underinvestment because we know that at the firm level, this is a positive NPV project, right? So we should invest in this project. However, because of debt overhang, these shareholders, they will not want to finance this project. So this project will not get invested. There is underinvestment. And clearly, if a positive NPV project cannot get invested, then this will actually reduce the firm's value, right? Okay, now let's see the third form of agency cost. It's called cashing out. So here it basically says when a firm is facing this financial distress or the potential of bankruptcy, shareholders, they will want to withdraw money from the firm. So basically you can imagine that cashing out is an extreme case of underinvestment, right? Because you can see that debt overhang basically means the firm will not make investment. And cashing out means, well, not only the firm is not making investment, the firm is actually, cashing out means not only shareholders are not making new investment, and shareholders are actually actively withdrawing money from the firm. So it's a more extreme case compared with debt overhand. So again, let's see this very simple example. So let's say this firm has a equipment. Oh, what happened? Sorry. Let me go to the correct page. Okay, so let's say the firm has a equipment. It can sell for $25,000 at the beginning of the year, and then selling this equipment forces the firm to shut down some operations, and this will reduce the firm's value by $100,000. And again, this firm will default at the end of the year, and obviously, if the firm will default, the value of equity will just become zero, right? Now, will shareholders want to sell this equipment or not? Well, the answer is pretty easy to see, right? So let's compare two scenarios. So shareholders don't sell. So if they sit there, right, they do nothing. If they don't sell this piece of equipment, then after 1 year, the value of their equity would be just zero. So if shareholders sell, so they will get $25,000. So of course they should really do this, right? And you can see that this is inefficient because the gain is $25,000, but the loss, again at the firm level, is $100,000. So the net loss is minus $75,000, right? So this is essentially a negative NPV operation. Right? So from the perspective of firm value, shareholders should not do this. But why do they still want to do this? Well, again, it's very easy to understand, right? Because you know that if you do nothing, in the end, you will get nothing. So why not first get some money from the firm? And you can see that doing this is inefficient because it reduces the firm's value. However, the reduction in firm's value will be borne by debt holders. So essentially, again, by cashing out, shareholder is really again hurting debt holders by benefiting themselves, right? Okay. Let me see if I want to continue with this. Okay. Let's just stop here because I think I am pretty much ahead of the course schedule. So I will just stop here.